2026, Elon Musk is worth more than $780 billion. That number sounds unreal, almost mythical. But here's the strange truth. Almost none of that money actually exists. There's no massive bank account, no hidden vault, no mountain of cash waiting to be touched. Instead, his wealth lives inside stock prices, private company valuations, and investor belief. If Tesla's stock drops, if SpaceX loses confidence, if the AI hype cools, his fortune can shrink fast. So the real story isn't how rich Elon Musk is. It's how his money actually works. Because what Musk built isn't just a collection of companies. He built a financial machine engineered to convert risk, vision, and timing into unstoppable momentum. And it all began with a single gamble that nearly destroyed him. Elon Musk is not rich in the normal way. He doesn't live off salary, doesn't rely on dividends, and doesn't store billions in cash. Almost 99% of his wealth is tied to ownership shares in Tesla, SpaceX, Starlink, XAI, Neuralink, and X. This is called equity wealth, and it's powerful, but it's also dangerous because equity doesn't guarantee money, it only guarantees volatility. Your net worth can double in months or collapse overnight. In 2026, Musk's equity machine is firing at full speed. Tesla's full self-driving rollout is turning cars into AI-powered robots. SpaceX and XAI are merging space infrastructure with artificial intelligence, and Starlink is becoming the backbone of the global internet. On paper, it looks unstoppable, but this empire was never built from comfort, it was built from near disaster. And the closest Musk ever came to losing everything was 2008. By the end of 2008, Elon Musk was almost finished. Not struggling, not under pressure, finished. The global financial system was collapsing, banks were failing, credit had frozen, investors were terrified, and 3 of Musk's companies were bleeding cash at the exact same time. Tesla was burning millions every month trying to finish the Roadster. Production delays were stacking up. Costs were exploding, engineers were quitting, suppliers wanted cash up front, and customers were demanding refunds. SpaceX was in even worse shape. 3 rocket launches had already failed. Each failure destroyed tens of millions of dollars. NASA contracts were on the line, investors were pulling back, and the next launch would decide whether the company survived or disappeared forever. Solar City was also bleeding. The solar market was still immature, and financing had dried up. Expansion plans were collapsing under rising interest rates. Meanwhile, Musk himself was nearly broke. After selling PayPal, he had poured almost every dollar he owned into these companies. Not some of it, not most of it, almost all of it. More than $18 million gone into Tesla, SpaceX, and Solar City. By late 2008, his personal bank balance dropped to levels that would terrify most normal people. At one point, Musk later admitted he had to choose which company to save, knowing the others might die. This wasn't a strategy anymore. This was survival. Then came the moment that changed everything. SpaceX prepared for its 4th launch. If this one failed, the company would almost certainly collapse. There would be no money left, no investors waiting, no bailout. One more explosion, and SpaceX was dead. The rocket lifted, the engines fired, the countdown reached 0. And this time, it worked. The Falcon 1 reached orbit. For the first time in history, a privately funded liquid fuel rocket had successfully reached space. That single launch saved SpaceX. Days later, NASA awarded SpaceX a $1.6 billion contract, instantly pulling the company back from the edge of bankruptcy. Almost at the same moment, Tesla secured a last-minute funding round that barely kept the company alive. In a matter of weeks, Musk went from total collapse to fragile survival. But the real lesson came from what he did next. Most people, after escaping financial disaster, become cautious. They protect their money, they diversify, they reduce risk. Musk did the opposite. He doubled down. Instead of pulling back, he went all in on a financial philosophy that would define the rest of his empire. Extreme concentration, maximum reinvestment, total commitment. And that decision created the engine that would later multiply his wealth beyond anything Wall Street had seen before. After surviving 2008, Elon Musk made a decision that would define the next 2 decades of his life. Instead of protecting what little financial stability he had left, he chose to concentrate his risk even further. He didn't diversify. He didn't spread his investments across safer assets. He didn't retreat. He pushed forward, placing nearly all of his wealth into a small number of companies that were still years away from profitability. This strategy directly violated conventional financial advice. Most wealth managers recommend diversification to reduce risk, but Musk followed a different philosophy. He believed that real breakthroughs only come from extreme focus, and that concentrating capital into a few high-conviction ideas produced far greater outcomes than spreading money thin across dozens of moderate opportunities. In his mind, if something was worth doing, it was worth doing completely. Tesla, at the time, was little more than a fragile startup fighting for survival in an industry dominated by century-old automotive giants. SpaceX was still viewed as an ambitious experiment, barely tolerated by government agencies and largely dismissed by traditional aerospace companies. SolarCity was struggling to prove that residential solar could ever become financially viable. Yet Musk placed his financial future into these companies without hesitation, betting that technology, scale, and timing would eventually overpower market skepticism. The emotional pressure was enormous. For years, Musk lived under constant financial strain. His wealth existed almost entirely on paper, tied to stock prices and private valuations that could evaporate at any moment. Public criticism followed him everywhere. Analysts labeled him reckless. Media outlets questioned his sanity. Investors accused him of gambling with other people's money. Even his closest advisors warned that he was one bad quarter away from collapse. But this pressure created something else: velocity. Every dollar Musk earned or raised was immediately reinvested into product development, infrastructure, and long-term research. Instead of extracting profit, he fed the system. Each company became both a risk and a catalyst for the others. Tesla's rising valuation attracted attention. SpaceX's technical breakthroughs created credibility. SolarCity provided early energy integration. Over time, these ventures began reinforcing one another, accelerating their growth faster than traditional companies could manage. This approach transformed Musk from an entrepreneur into a capital engineer. His companies no longer relied purely on sales or short-term profits. They relied on belief, execution, and momentum. Investors began pricing in not just present performance, but future dominance. And that future premium became the fuel that allowed Musk to raise billions without surrendering control. As Tesla stock climbed, he gained access to unlimited capital markets. Instead of borrowing heavily or selling personal assets, he issued new shares, raised cash, and reinvested it directly into expansion. Gigafactories, battery research, self-driving software, and global production networks were built not from profits, but from market confidence. SpaceX followed a similar path, converting technological success into valuation growth, which in turn unlocked larger contracts, larger launches, and ultimately, Starlink. This cycle slowly formed an engine. Rising valuation produced capital. Capital produced expansion. Expansion produced dominance. Dominance produced even higher valuation. The loop reinforced itself, growing stronger with every iteration. And yet, this financial structure remained fragile. If market confidence ever broke, the engine would stall. Musk understood this risk better than anyone, which is why he developed a strategy used quietly by the ultra-wealthy to maintain control, liquidity, and power without ever selling their core assets. That strategy is known as buy, borrow, die, and it's the hidden financial weapon behind Musk's empire. As Musk's wealth exploded, he faced a problem most people never encounter. How do you use billions of dollars without triggering massive taxes or losing control of your companies? The answer was simple but powerful. He stopped earning money. Instead of paying himself a salary, Musk used his stock as leverage. Banks were willing to lend him billions, using his Tesla and SpaceX shares as collateral. These loans gave him liquidity without forcing him to sell ownership. And because loans are not considered income, they are not taxed. This allowed Musk to live, invest, and even make massive acquisitions without triggering huge tax bills. The Twitter acquisition, now X, followed this exact model. Large portions of the deal were financed not by selling shares, but by borrowing against them. This strategy kept his core assets intact while still giving him access to enormous cash flows. His wealth remained invested, compounding, growing, and multiplying, while borrowed money handled the short-term needs. It's quiet, it's legal, and it's how the richest people on Earth preserve their dominance. But Musk didn't stop there, because by 2025, he unlocked the final multiplier: artificial intelligence and space. By merging SpaceX with xAI and integrating Starlink into a global data and computing network, Musk created something entirely new. Space was no longer just for rockets. It became infrastructure. AI was no longer just software. It became an intelligence layer that connected his entire empire. Suddenly, Tesla cars were feeding data into AI systems. Starlink was distributing global connectivity. SpaceX was preparing orbital computing platforms. And xAI was tying everything together. This wasn't just business, it was ecosystem engineering. And that system pushed Musk's paper wealth beyond $780 billion. Not from savings, not from salary, not from safety, but from ownership, leverage, timing, and risk. Elon Musk didn't build his fortune by protecting money. He built it by deploying it, by concentrating risk, by reinvesting aggressively, by turning ownership into leverage. His story proves one brutal truth. Massive wealth does not come from working harder. It comes from owning better. Do you think Musk's wealth is a bubble waiting to burst? Or is he building the blueprint for the first trillion-dollar fortune in history? Drop your thoughts in the comments.